Today, we're going to talk about choosing an entity for your business. We're going to go over an overview of the various entity types. But first, we're going to kind of start with a problem because all great businesses they start with solving a problem. And so, one problem that I've encountered in my life is I'm very busy, constantly doing things, chasing kids around, trying to run a business, and I just don't have time for laundry. So we're going to try to talk through choosing an entity through solving that problem, through being able to take care of laundry. So perhaps we might form a company to handle this laundry problem that has a physical location, that has some tangible assets like a washer, dryer, things like that you'll need, some detergent. Um, and we can basically tell from this business that we'll have, some short-term cash flow. We'll be able to say, hey, this is how much it's going to cost for this equipment. This is how much it will cost for the detergent and all the stuff. And we'll be able to figure out a way that we can make profit really quickly. Now, this business is going to be relatively local, right? If we're going to run a laundromat, it's probably going to be in a particular place, and it's not going to be over the country, at least initially. And we're going to have some employees to kind of, run the day-to-day operations. And so we could call that you wash. Perhaps it's something that you would wash. So that's one business model. But I also have another business model that is a little bit more, I'd say, scalable. So we call this we wash. And so instead of having a physical location, instead of having tangible assets, I'm just going to create a platform, a website, a mobile application that kind of acts like a marketplace, right? So I can maybe have some folks that already have washers and dryers, and they can register on the application, and they can offer their own driving service, come pick up your laundry. They can take it to their own homes. They can make a little bit of money on the side by washing clothes, drying them, and delivering them right back to your house. And so this type of business, it doesn't have any tangible assets, right? It's mostly made up of intangible assets, right? Branding, computer code, other forms of intellectual property. Now, with this business, I'm going to have to take a lot of capital, a lot of time to develop all this product, develop the code, develop the market, all the marketing. And so it's going to probably take me a while to be cash flow positive. But it's scalable. I could offer the service across the world. And I'm not going to really need day-to-day employees for the most part. Most of the drivers are just going to be contractors. So we would call this we wash. And so we look at choice of entity. We're going to look at this in the context of you wash versus we wash. So at first, let's kind of get rid of some of the entity choices. Let's go over the entity choices and get rid of some as well. So basically, you have two categories of entities. You have those that are defaults, such as sole proprietorships and general partnerships. And these are ones in which if you just start operating a business and don't register anything with the state, they're defaults. If you're the only person, you're the only owner, it's sole proprietorship. If you're working with another partner or someone else, then that would be a general partnership. Now we have the business entity structures that are affirmatively formed with the state, such as corporations, limited liability companies, and limited partnerships. We're not going to talk much about limited partnerships. I'm mostly going to spend this time talking about corporations and LLCs. And the reason for that is because of limited liability. The difference between the defaults and the ones that are affirmatively formed with the state is a thing called limited liability. Limited liability is a concept that separates stakeholders from the actual business itself. And when we're talking about stakeholders, we're talking about the owners, the employees, the directors and managers, the various people that are involved in the business. And so when you have limited liability, you're basically separating the entity as a separate and distinct person from the individual owners and other stakeholders involved. So let's go back with an example here to better understand how limited liability comes into play. So let's say a we wash driver accidentally stains a customer's dress. If we wash is formed as a corporation with the state, then the customer would only have a claim against we wash, just generally speaking. And they wouldn't have an individual claim against the driver or the owners or the directors of we wash. So limited liability is the biggest reason that we are going to form an affirmative corporation or LLC or something like that. Basically, the concept of we don't want our personal assets to be reached by creditors or individuals that we come in contact with, whether it's damaging property, breaching a contract, or getting in some other type of dispute. And so when we're talking about entities that are formed affirmatively with the state, we're going to focus on corporations and LLCs. In later sections, we'll discuss limited partnerships very, very briefly because they hold a special place as far as entity structure, but they're for a particular type of business that isn't generally going to apply with what we're talking about. So corporations and LLCs, they share a lot of common characteristics, including limited liability. They're also useful for issuing, tracking, and transferring ownership. So issuing ownership in a corporation would be issuing shares of stock. In an LLC, that'd be a membership interest. Tracking it, you can give a physical stock certificate or you can record it on a ledger. And transferring ownership, you can hand that stock certificate to somebody else or record the transfer on the books and records of the company. It's also important to have an entity to hold property, right? If you're going to be able to sell the business has to own the actual property. This could be washers and dryers, or this could be intellectual property like trademarks, patents, know-how, trade secrets, things like that that a business could have title to. Now, there are common benefits, and there's also key distinctions between these types of entity structures that we need to think about within the context of you wash and we wash. The main three are governance, tax, and funding and exit strategy. As far as governance, corporations are said to be a little bit more formal. I don't know if that's necessarily the case, but they do have a more formal distinction between the owners, which are the stockholders, the managers, which are the board of directors, and then the officers, which carry out the day-to-day operations of the business. And with a corporation, how it generally is governed is that the stockholders vote and they appoint the board of directors, and the board of directors appoint officers, and the officers can hire and fire employees. With an LLC, you can have a structure similar to this, but generally speaking, the owners and the managers tend to be the same person. You might have a manager-managed LLC. You might have a member-managed LLC. They're just a little bit less formal. Corporations also require a little bit more affirmative filings with the state. And so that adds a little bit more formalism there. The big difference is tax. Okay, so we're going to go through this briefly, and I'm going to talk mostly from the context of a corporation that is a C corporation. So a C corporation pays an entity-level tax. So if it receives $1 million of income, it has to pay tax on that income. Now, if the company was an LLC, it's usually considered a pass-through or disregard entity depending on the number of owners that it has. So what that means is that the LLC itself doesn't actually pay taxes on the $1 million of income. Let's say the LLC was owned 50-50 by Alice and Betty. And if they have $1 million in income, instead of the entity itself paying taxes, the tax obligation passes through to the actual individual owners, to Alice and Betty. And so they would be required to pay 50% of the tax that's associated with that $1 million each. This is also what you have with an S Corp. It's also a pass-through type entity. For the purposes of this video, we're not going to spend too much time on S Corps, basically because S Corps, they're corporations, so they have the formal structures in place, but they also have some limitations on ownership that kind of make them a little bit outdated when you consider the LLC option and also the corporation option. So going back to that entity level tax, this creates what's called a double tax. So if the corporation is required to pay taxes on its $1 million of income, and then it decides to distribute or pay a dividend to its individual stockholders, then those stockholders will also have to pay tax on that dividend income or that distribution income. And so there's two levels of taxes there. And so you might be thinking, I don't want to pay two levels of taxes. Why would I be a corporation? Well, a lot of companies that are kind of like WeWash, they don't really have a lot of income to begin with. And we'll kind of go over this throughout the various videos and explain this in more detail, but they're generally not going to be cash flow positive in the short term anyways. So it's not going to be much of an issue. And they can also kind of zero out that income by paying reasonable salaries and things like that. The last point, and probably the most important point, is the funding and exit strategy. What are your long-term goals? Let's look again at WeWash and UWash. Let's look at the characteristics that are involved there. With UWash, you're much more local. You might be a family-owned business, right? So the concept of exit might just be carrying on to the next generation or maybe selling to another laundromat. Where with WeWash, this is highly scalable. We might be able to go all over the country. And so perhaps we would, register our shares on the stock exchange and be able to go public or sell to a bigger acquirer. And so we're talking there back again about funding strategies. One of the big points that we're going to discuss throughout the different sections is venture capital. Venture capital is appropriate capital raising mechanism for a very certain type of business. And that generally follows with the WeWash model. So venture capital, they're professional institutional managers of risk capital that support the most innovative and promising companies. And they do this because for companies that are unable to obtain traditional bank financing. They're also companies that threaten established products and services. And then they also have a little bit more of a maturity period. And this is the definition that's supplied by the National Venture Capital Association. So let's take a look at those in a little bit there in the context of WeWash and UWash. Could not be financed by traditional bank financing. Well, it's going to be difficult for WeWash to get traditional bank financing because they're not cash flow positive. A bank is going to want to be able to see that you're able to make payments of principal and interest and do that in a timely manner. They're not interested in the upside. They want their money back and they want interest back. Now, UWash, that's cash flow positive pretty quickly. Perhaps they could easily get a bank account. As well as high scale there. We talked about innovative businesses that have threatened products and services. UWash, we're not really threatening anything except maybe another local laundromat. WeWash, we're disrupting an entire industry. And we think about how long it's going to take for that business to become profitable and to get to the next stage or to exit. UWash, it could happen really quickly. It could be cash flow positive in a number of months. WeWash, it's going to take a lot of research and development on the front end that's going to push back that date. So when you're trying to figure out how to fund a business, you need to ask a few questions. How much time and money will it take me to generate revenue? With UWash, that was relatively quickly. What about profit? This is probably not going to happen with WeWash anytime soon. It's going to be focused on growing as fast and as big as possible. What are the growth projections of your business? Are you expecting gradual growth? Over time, you'll grow slowly and consistently, or do you expect exponential growth? You'll grow very, very fast, very, very quickly in large quantities. And is your venture too risky for a bank to finance, which is what we see with WeWash and probably not what we see with UWash. So now that we've kind of looked at those in tandem, I would say generally speaking, when we're talking about UWash, we're talking about an LLC. We're talking about WeWash, we're talking about a corporation. And so it's very important to take a look at these things and make these entity-level decisions based on your actual business. And so I hope that this was helpful in helping you decide what type of business you kind of fall in. Does your business fall in the UWash category? Does it fall within the WeWash category? Hopefully this helps you make a better decision there. And so until next time, venture awaits.